Rohit, मेरे दोस्त, मेरे यार, so good to see you, man. Finally on the show. Welcome to Paisa Vaisa. Thank you so much for doing this for our listeners.
Anupam, it's a pleasure to be here. I'm
Yeah.
seeing you after 4 years. I just can't imagine it's been 4 years. And thanks for having me, but
My
I'm really
pleasure.
excited.
My pleasure, folks. I'm getting emo because यार 5 साल हो गए podcast करते करते and I've never had a friend. Okay, I will get over my emotions. But true weekend, folks. If you remember, Nikhil Kamath was with us in March 2021 in the middle of the second wave, and we were talking about the crazy surge in demat accounts, change in wealth management, and other stuff. And here we are now. It's 2022 is almost over, and again the world has changed this year, and it looks totally different. Rohit, what's been happening in True Beacon? When did you join, by the way? And folks, just a small, Rohit has an origin story. I wish I could do an entire episode on that. You are a CA. You are an MBA from Stanford. You have done God knows how many things. Do you still have that bike with you?
Not yet. I sold it when I left
You'll get a
India.
new one in Bangalore.
I'm almost planning to buy the new Royal Enfield, hopefully soon.
Royal Enfield fan, of course. Okay. Talk to us about that. What's been happening at True Beacon? When did you join? You've got a PMS. A lot of stuff since we last spoke with Nikhil back in March 2021.
Anupam, couldn't agree more. The world has clearly changed since 2021. Obviously, we came out of pandemic, and I think there were a lot of learnings people got through the pandemic, and then we had a global inflation crisis. Apart from what's happening in Russia and Eastern Europe, uh, so I think True Beacon has evolved a lot since then. First of all, we launched our wealth management operations middle of this year. We had a good start to that. Secondly, I joined the firm end of last year, but I formally took out the charge as a CIO in April of this year. When I joined the firm, we were about 4 people team on the investment side and under 20 people. I think when you met Nikhil, we were probably 18 people. Today, we are close to 40 people team.
Wow.
And our investment team, which comprises of both investment people as well as the technology people which support investment team, is about 14 people.
Wow.
So we have people across data, risk analytics, trading infrastructure, execution, fundamental research, quantitative research, algorithmic trading, as well as wealth advisory and asset allocation. So very diverse set of team we have built. And as you know, we recently also launched our PMS strategy as well. So it's a great phase of growth which we are going through, and very excited to be part of this.
Yeah, just for the benefit of our listeners, in March 2021, you just had the AIF.
Yes.
And when you say wealth management, it's a slightly broader product for a wider public. You just walk our listeners through the products that you have and who are they meant for.
Okay, so in 2021, we obviously had a single AIF. Since then, we had 2 more AIFs. One is more of a passive strategy, currently experimental, but we launched a mirror AIF for global investors out of Gift City. We were the first hedge fund to start hedge fund
Wow.
out of Gift City. Now, obviously, there are a multitude of funds which have operations out of Gift City, but we were the first one, which is a mirror fund for our domestic fund. And on the wealth management side, we have a PMS strategy, which is a long-only equity quant strategy. But apart from that, we are doing full bouquet of wealth advisory. This is focused on HNIs and ultra HNIs. And this is basically providing them very tailor-made services, unfiltered, unconstrained, and unconflicted. And that's another change I saw in India is like people are willing, people want advice, like which was not the case when I left India. So big evolution for Indian market.
Very interesting. So you're saying you've got the products and you're also doing advisory.
Yes.
That's very interesting. And how has wealth management changed in these past 2 years? Okay, we went into COVID. Entire 2020 was disrupted. You had 2021 with the first wave or second wave, and a lot of stuff has been happening. But what's happening right now? You had a lot of money coming in at that point of time, because I guess what I heard and the conversation that I had on Paisa Vaisa was a lot of the HNIs were shifting money from mutual funds to wealth management. Wealth management guys were seeing massive inflows and a lot of things were happening. Has that ebbed out now? Things are getting back to normal. How do you see things as of now?
So I think there is a structural shift in the economy. I don't need to tell you, you're already aware. Like, 85-90% of Indian assets used to be in, real assets, real estate,
Gold.
gold, and other. Most of the people's wealth was concentrated between these two plus their businesses, if they were in business. I think there is a shift which happened where people are moving towards financial assets. About 4.8% of Indian savings now are getting invested in equity markets. It's still a tiny number, but given that annual savings are about $700 billion, that's a sizable number. And the fact that they are so small and they are growing, I think it's a very positive from Indian economy perspective. I think what people are realizing is that real estate, if our central bank does its job, which I believe they are doing very well over the last decade or so, uh, real estate will give subpar returns. See, real estate has always outperformed if you have a sustained long-term inflationary pressures in the economy. Real estate will be the best asset class. But I think global central banks have started this coordinated effort of containing inflation, which has been working out well. They've learned their lesson that they cannot talk inflation down, after the recent episode, but their coordinated effort has paid off well. And I believe the current scenario will come under decent amount of go down to a decent situation pretty soon.
Yeah.
And in that scenario, I don't think so real estate will be, or even for that matter, gold will be an asset class where you'll see outsized return. So I believe this transition will continue. That's my thought process.
Are you saying that because in Bangalore, Bangalore is a place where all the startup action is happening and a lot of founders are out there who do deals, they get money, and there are also a lot of young people. So what I'm asking you is this: is this trend? Do you see this trend as all India trend, or do you see a lot of wealth coming in into what I call financial assets? What you spoke about are physical assets. You think this is going to actually sustain going forward just because real estate is not going to give you that rate of return? Because you know how the stock markets function.
Yeah.
The thing with having something like an FD or with real estate is that you get an annual return. There is something in your head mentally ki theek hai, you're getting so much of yield, even though that yield is quite low. Equity returns are volatile. Nifty's gone nowhere for 1 year.
Yes.
A lot of people think that when this happens, you might just have a shift back into real estate. Who knows? What do you think?
So see, if you look at real estate, I don't think so. Over the last 1 year, you would have seen great real estate returns. There is a positive return, but real estate gives you about 2% yield, or rental yield. Stock market gives you about 1.5% dividend yield. So they kind of balance out each other. But if you look at stock market, yes, it has been flat. But SIP flows are not right.
Yeah.
Right?
That is amazing. Yeah. You have any insight? I mean, what do you think is happening out there? Yeah? 13,000 crores a month is like what, 1.5 bill, right?
I think it's good, right? People have figured out that, listen, if my wealth is growing over the last 5 years, when I look at my portfolio and I see positive return, most people are not looking at, listen, what happened to my last year's tranche? They look at their cumulative and they say it's a massive return. They say, okay, I don't care where market is going. This thing is working for me. Let me keep investing. And I don't think so that's changing. And I think that's good for our country because it means the equity market participation, wealth creation participation is moving just from upper middle class or rich class down to, let's say, true middle class and even lower middle class. So I think that's a good for the economy. I believe it will sustain itself.
Yeah. Let's talk about the PMS. I mean, you've launched your PMS in what is now become a very competitive market.
Yes.
Ek zamane mein to, of course, the PMS was not that well known, well understood, well discovered. But today you've got PMS platforms. A few of them have been on Paisa Vaisa also. A lot of people are savvy. A lot of people think that HNIs, that is, because now I believe the ticket size is about 50 lakhs plus or something. Somewhere that PMS gives you a higher return than stock markets. I'm not really sure about that. What is your PMS about? How is it different from others?
Okay, so first of all, we are a pure quant strategy. Our current PMS strategy is a pure quant strategy. Two, it is differentiated from the street on the long-only side. Long short is a separate discussion. On the long-only side, that it's an active quant strategy. You will see a lot of mutual funds and PMS shops have quant strategies, but most of them are passive strategies and are style strategies. Some are value, some are quality, some are momentum. We are we have launched a product which is not a style product. It's an active strategy where we are actively trying to beat the market, and not beat the market by, let's say, a small amount, but give decent upside in terms of risk-adjusted returns. And we are basically relying a lot on data science. We're moving away from traditional, econometrics-based quant investing, which works reasonably well, but it, after taking into account fees and taxation, you basically realize you potentially could have been better off in index investing, because you have to pay higher taxes over here, right, compared to ETF. But what we are doing is we are marrying data science with behavioral analysis, with quant investing. So that is working very well for us. I have worked in this area for over last 10 years. Since 2012, I've been researching this. And the results have been very good in international markets. Obviously, I launched this product very recently. Very excited. Let's see what the future holds.
Is this yours?
Yes.
Wow, that is something. Because is there any continent on this planet you've not stayed? You've been in Frisco for back in when you were doing your this. You've been in Singapore. You've obviously been in India. Two things. One, how does this work globally? Is this a well understood product? And two, at a generic level, how do you think this is going to work in India, where I think there is still some amount of information arbitrage, some amount of action out there? Just explain this to us for our listeners, because this is relatively new. We've never spoken about this in our podcast. Quants, that's based on what you just said.
So see, there are two aspects to it, right? First of all, in global markets or even in India, factor quant, what the PMS strategy relies on is nothing new, right? It's been around for ages. What is different is our approach to factor quant. Our approach is rooted in data science, scientific analysis of data, but also understanding human behavior. And that's what differentiates us from the street. Is that, data can tell you a lot of things. What you have to ask yourself, what part of it is once in a lifetime and what part of it is likely to repeat consistently over the coming few years. The reason is you have to tie in what data is telling you, what your economic, theory of valuation tells you, and what human behavior you observe. And what we are playing is very simple thing, that our economic theory says investors is rational and markets are hypothesis. In my 20 years in markets, I haven't met a mythical creature called rational human being. So we are saying we are not rational. You and me are not rational. We are emotional beings. Hundreds of thousands of years of our evolution, basically we have fight or flight response. That gives us interesting opportunity if we can marry these three things together: data, economic theory, and human behavior. We can spot opportunities which, with the help of rigorous data analysis, data science techniques, and computational capabilities, to figure out what are the inefficiencies in the market and how to take advantage of that.
Yeah. And just give me a bit, right? Folks, if you think, there's a lot of stuff to unpack out there, I'm sure. We'll get into all of that. On the other side of this break, three things you said, right? One is the whole data science, macro theory, human behavior. That's like all three of them are pretty massive. We can give our listeners some examples. Right?
Sure.
So, folks, we will get to all of that on the other side of this break. Don't go anywhere. We'll be right back.
Hi, hello everyone. It's been another great week on the IVM Podcast Network. On The Habit Coach, Ashton explains why it is important to have opinions and why opinions attached with facts make an impact. On The Life Manifesto, Zarina explains what are manifestation blocks and how they create hurdles in your manifestation path. On Polyabazi, Pranay, Khyati and Saurabh discuss India's first public library movement and question if libraries are relevant in the country. On Smarter with Sid, Siddharth explains tall poppy syndrome and shares some tips to overcome it. And on The Longest Constitution, Priya looks at how courts interpreted Article 21, which assures a citizen's right to life or personal liberty. Once again, don't forget to visit our merch store on ivmpodcasts.com. We have some exciting stuff for you. Follow us on social media. We are IVM Podcasts on Twitter, Facebook, Instagram, and LinkedIn. If you like our shows, spread the word. Tell your friends and don't forget to rate and review them wherever you're listening to them. You'll also find all our shows on youtube.com kotak.com/IVM podcasts. And finally, we would like to thank our sponsors this week, Kotak Privy League Program and HDFC Mutual Fund. Thank you for making this possible.
And welcome back. Okay, let's talk about specifics out here. Okay, the whole thing about what you said about data science and economic theory and human behavior, right?
Yeah.
Maybe 10, 15 years ago, it used to work. I remember because I used to do this, the whole Infosys results thing. You know, you would have an estimate of Infosys results. Overnight, there would be estimates and you take a position and boom, Infosys results would come out and it would be pre-market or maybe post-market. I don't know. You take your call and that's it. You're done. Now, that would be some kind of a play on getting broker estimates, maybe applying your own thought to that, and that's it. Do the trade. You're done and dusted. That's 10 years ago. From what you're saying, things are very different now. So okay, let's talk about what you said on the previous side of this episode, and let's go deeper into that. Examples would be great.
Okay, I think you picked a very right example to talk about. I think world has changed, but sometimes more things change, the more they remain same. So I was the other day discussing with one of my fundamental analysts about how to look at management, quality of management. We all agree that quality of management is very important in terms of a stock performance. And we were discussing various metrics, and he said one thing he looks at is the guidance, which you were talking about, what management guidance is giving. And if management guidance is consistent, he likes to buy those stocks, provided guidance is on the positive side, because sometimes guidance is bad. Because those stocks tend to outperform because managements are giving you good guidance and you can invest based on that. And the question for me was like, how do I quantize that? How do I go and analyze that? Because different managements give different kind of guidance. Some gives you EPS guidance, other gives you unit sales guidance, other gives you growth, EBITDA guidance.
Some don't.
Some don't.
Yeah.
Right. So that was an interesting challenge for us. So, there's no direct way I can measure that, but there's an indirect way, which is if management is giving guidance, good or bad or ugly, analysts are using that guidance in their estimates of the earnings. And if guidance is good, the analyst estimates should be very concentrated, should be closer to each other and should be not very far off. They cannot be too away from what management is saying. And if management gives bad guidance, which is unreliable, analyst estimate will be all over the place because they have to rely on their own methodologies and own skill set to come up with the reliable estimates. We went and basically started getting the data of various analysts. We started analyzing it, saying, okay, let's look at the dispersion and say, does dispersion explain the return of the stock? Can I invest based on that? And the answer is yes. Now, when my fundamental guy was looking at that signal and the results, he was saying, there's not much there. I said, actually, there is a lot because I haven't denoised the signal as yet. A raw signal giving me this kind of information is good. Then we sat down and said, let's look at sector specific, because for right now we are just looking at EPS. You can look at different measure for different industry and then say what is dispersion around it and trade based on that dispersion. If you can combine your domain knowledge of the markets, which is economics and accounting and finance, with how you think about data, like you are combining human behavior over here because you're saying, what is market looking at, right? Technically, as economic theory, none of this should matter. Everything is priced in. Yeah. But when you carefully, diligently look at that signal, you find that, yes, there is explanatory power in this signal, and you can invest based on dispersion in analysts' expectations. So that is an example where all three parts get covered.
I chartered accountant, you're a CA, right?
Yes.
When did you learn all of this stuff? It wasn't in my syllabus when I was doing my CA. You actually picked all this stuff up as you progress in your career?
So, I started this at Stanford when I was doing my MBA over there. Engineers go to business schools to move away from engineering. I went to business school and got into the world of data analytics. Yeah. I quickly realized not enough. I don't know enough math. And then I started learning math. Then I enrolled in master's programs in data science. And that started my journey.
Yeah. I want to ask you, this from a career perspective. I don't know if our listeners are looking at this because I know that this is the future. Okay, it's probably the present already. But remember when we got into the markets, it was you have to be a CA, or an MBA, and then of course you do your job, you get a CFA also along. What would be your advice to someone who say that I want to join the stock markets as an analyst or as a fund manager, and he's probably considering his graduation? What would be the hot areas there where you feel the skills here are really going to matter to you if you want a career in the markets? What do you think?
So, I think I tell people most important thing in market is one is critical analytical thinking. Uh, it does not matter what tools you use, whether you're using Excel to build your model or Python to build your models. It's not relevant. What is relevant is, are you investing time in learning? Markets is one area where your knowledge gets dated very, very fast. So if you're not excited about reinvesting in your upgrading your knowledge on a daily basis, stay away from it. So I see today I sit with my fundamental analysts almost on a daily basis to understand their insight, which I can translate into my models, right? So anybody who thinks like quants alone can do it, I don't think so. I think the world of quant is also getting so competitive that there is a room for everyone. We need that skill set. Information is information, doesn't matter where it comes from, how it is processed. What matters is it relevant? Is it high quality? Is it tradable? But having said that, I think it's good idea for anybody today who wants to be in financial world to pick up basic coding and to pick up statistical skill set. It'll go a long way because as the world becomes more complicated, you have to move beyond Excel. You don't need to become data scientist or data analyst to succeed. But like today, you can't do without Excel. I think tomorrow, Python will kind of replace Excel. So you need to have those toolkits in your repositories.
यार मेरे ज़माने में तो बोलते थे एक एनुअल रिपोर्ट पढ़ने आता है आपको तो आ जाओ काम करो. You're like you're really making this difficult, man. Annual reports are still important, right? Come on.
Absolutely.
Yeah.
But you can read them via machine much faster.
Yeah. Thank you for that reality check. Okay, break down these few concepts to us. And first, I think the generic question that I have is, what is quant? I know that's a quantitative way of investing, but what is data science, NLP, ML, AI, and how are these playing a role in the stock market? Because these didn't exist a very long time ago. Today, they've become really important. Just tell us these few terms and how they operate now, either at a quant level or any other way.
So see, quant is a very wide term. It includes things like algorithmic trading, statistical arbitrage, any kind of computational based investing you are doing. See, data science is a multidisciplinary skill field where you are combining computer science because you're playing with large swaths of data. You can't process that in Excel. So you need computer science, computational capabilities to process that and to get meaning out of it. So it's a combination of traditional statistics, modern machine learning techniques, computer science, and good old domain knowledge. So it's a very all-encompassing terms. Within that, machine learning, is a branch of statistics where you are basically moving away from traditional linear regression. Linear regression is machine learning. But what happens is for most use cases, you find that it's not good enough to give you robust signal, particularly where people are trading against each other, right? The noise is massive. So machine learning refers to advanced techniques where you are learning how to basically play with the data, get information out of it in a more non-linear fashion, but paying importance to things like overfitting, things like not figuring out difference between a real and a spurious correlations and causation.
Common language, ELI 5, explain like M5. Okay, so what I'm saying is, let's take a theoretical example. Interest rates are going up. Banks obviously will be affected. How would you use quants and whatever you just said right now to actually take a decision to say buy XYZ stock or take a position, short PSUs, buy private or whatever it is. I'm saying, give us an example of a situation and an action on how this works.
Okay, let's take banking is a good example, right? Think about what are the metrics people are looking at, right?
You'd
Return
have,
on assets.
loan growth, stuff like
loan growth. Where is the loan growth, right? Retail versus
that.
corporate.
Yeah.
You can decipher all those information. You can put all those in the models, and you can go back in history and say, if I look at these data points and I invest based on these data points, what would have returns look like, right? You have to obviously take the risk factors out. You have to look at returns which are residual returns, which are not explained by market moves or size or other risk factors. Once you have done that, so it's a reasonably long process and systematic process where you denoise your returns, you come to residual returns.
Denoise kya hai yaar? Say second or third time you're saying, I've never heard of this word.
So
you're throwing some fancy word at me, is it?
One of the challenges in financial markets is our data has a lot of noise. Our
denoise, okay.
Our daily returns. You can't basically say, listen, why markets went up today, why markets. If you look at intraday trading, there is no information which is coming up which can explain that amount of trading and which can explain that amount of variation in the stock market, other than demand and supply. Okay, so lot of the trading that happens in the stock market is actually, from an informational perspective, meaningless. It's a noise trading. If you look at market returns, you divide the market returns into close to open, which means overnight returns, and open to close. You will realize most of the returns we make actually happen while we are sleeping.
Right. Because that explains gap ups and gap downs.
Yes. Market on an average gains 7 basis points while we are sleeping and lose about 3 basis points a day while we are trading. So intraday trading, net is a losing affair.
Wow. Okay. Just on math.
Yeah, just on math. You just have to look at an average.
Overnight, gain 7 bips.
You lose 3 bips while trading. So net markets give you 4 basis points a day over the last 20 years. These are the numbers you can look at. Anybody can look at, right?
Daily, 4 bips.
It's not every day, but on an average,
I know. But
you make 4 bips a
just
day.
Thinking of the cost of trading also is there. Even if you are at zero, that's still, wow, that is tough. That is tough business.
Yes. So trading, basically there is so much noise in the market that if you look at that and you try to make sense of it, you will not get any meaning. You have to take that noise out. You have to figure out how to get rid of the noise and figure out what the real signal looks like. Markets data is more noisy than weather data, just to...
Market data is more noisy than weather data. Nice comparison. Sorry. So let's denoise out of the way. Let's go back to our previous example where you're talking about the banking sector. So how does that progress and what is the end out there?
So the end out there is you have to go and look for each factor. What does that factor tells you? You may be using linear regression. You may be just using statistical methods to saying, or decision trees, if then else. But you have to find out that there is a relationship which exists between factors and predictability power of the returns. Each individual factor usually is not good enough for you to make money on that. So you have to combine multitude of factors to figure out what investment decisions. Once we have repertoire of, let's say, 10 to 15 to even 100 factors, we have to pick what factors go together with each other. Because not some factors have conflicting signals. You don't want to combine them because your signal is going to go to zero. And there's cyclicity involved in that. So you have to think about those, build your models, and test your models. One important aspect is if you use your entire last 20 years of data to build a model, it's more likely than not to work because you have never kept a blind set of data to analyze what you found. Was it an accident, coincidence, or was it a real relationship? And there the data science principles, scientific principles of research comes in. So it's a very evolved mathematical process for you to basically 9 out of 10 times what you get is false signal and 1 out of 10 times you land a diamond.
Amazing. How big is this side of the PMS industry that you're getting into? Is it new? Are you the only guys out there? Are other products out there? Do you think that this will grow going forward?
I think if you look at the passive side of the quant, right, long only quant, mutual funds have been raking in money on the quant side. I think the signs are very clear that people are opening up to quant. 2014, when I came back from US and I tried talking to mutual fund houses, a couple of them actually told me I'm a fraud, con job.
Wow, are you serious?
Because nobody believed in that you can use data science or data analytics to invest in markets. But it's a completely changed scenario today. Every mutual fund house today has a quant strategy. It's mostly a passive strategy. If I'm not wrong, Marcellus is either just launched a quant strategy as well,
So,
right?
yeah.
So I see that this is the next phase of growth in PMS industry. It's going to be driven by quant, but active quant.
Man, look at that. 2014, people thought that this is a fraud. And I mean, you're actually offering to run a book for them using this method. And they were like, no, this is not work.
Yes.
बहुत देखा यार तूने. Okay, chalo, let's wind this up. Rohit, let's like make this relatable to our listeners. Simple question, क्या लगता है? I mean, where do you think we are? Where do you think we are going? Because we are almost at the end of this year. I think we are already at flat on a 1 year basis. I think the 5, 10, 15 year returns are still on a rolling basis looking pretty good. I think someone who's invested in the market is still beating inflation if he's held on for that long. Unfortunately, last 1 year, and FD would have given better returns. What lies ahead?
Okay. Anybody who's looking for 20% return over the next 12 months, I think is in for disappointment, in my opinion. Again, markets are markets. They have their own mind. Indian markets, I think, has outperformed the global peers if you look at it, right? Even dollar-adjusted basis, they have outperformed most of their global peers. Balance sheets are pretty clean. Leverage is low. Even on financials, books are probably one of the cleanest I have seen in my career. So from that perspective, I think we are in a good shape. From a downside perspective, I don't see much. But I don't see much upside either. I'll say India is divided into 3 parts. Urban demand-driven India, rural demand-driven India, global demand-driven India. So urban demand is doing very well. If I'm investing in equity markets, I will focus my portfolio towards urban demand. Whether it's financials, whether it is auto, whether it is consumption, healthcare.
Sure.
These sectors are doing well. Even though we are seeing some slowdown in reality, I believe we will see a stabilization and then pickup happening. So I will focus on that. Rural is a concern. I will stay away from anybody catering to rural side of the economy. And finally, global side. I think it's largely tech companies, IT services. They're still in growth phase, but growth is not as it used to be. So I will, for the time being, be a little cautious. Maybe stay underweight on them, but be watchful as the tide turns. See, US is coming out. It doesn't seem like US is going into recession. So I think at some times the purse strings will be loosened and IT companies will see pickup of demand. Europe remains a concern. So we'll see how that goes.
Folks, that's as specific as you can get. That is a wrap. That is a wrap on this episode of Paisa Vaisa. My guest, my friend, Rohit Beri, CIO at True Beacon. Rohit, thank you so much for doing this for our listeners and wish you all the best in this new job.
Thanks, Anupam. It's a pleasure to be here.
Fantastic.
No material on the show should be considered as financial advice. The material on the show is for informational purposes only. Please consult a financial advisor before taking any investment decision.